Tonight, we're not just explaining a trend. No, we are opening a cold case file on the collapsing value of Canadian higher education. Just imagine, the year's 2026, and for hundreds of thousands of new graduates, the system has completely defaulted on its single most important promise, a pathway to the middle class. So we're going to examine the evidence, we'll identify the accomplices, and then we're going to deliver the final verdict on an investment that has become, for way too many, a tragic sunk cost. That isn't hyperbole. That is the scene of the crime. For decades, a university degree was the safest asset a family could possibly invest in. It was a golden ticket, a social contract that was supposed to guarantee stability. But that contract, it's been breached. The asset has been devalued, and the balance sheet shows a generation is now completely underwater before they've even earned their first paycheck. Our investigation is going to uncover exactly how this liquidation happened, and it's going to expose the brutal math the institutions in charge really don't want you to see. $30,600. This is the average debt a Canadian student is carrying with them as they walk across that convocation stage. It's the anchor chained to them as they try to step into the 2026 job market. And this number, you have to understand, it's not just a student loan. It's the price of admission to a game that has been rigged. It is the primary piece of evidence in a systemic failure that has turned aspiring professionals into basically indentured servants of a broken economic model.
Our investigation begins here, at what we're calling the scene of the crime. This massive chasm that's opened up between the promise of higher education and the harsh reality of the 2026 economy. The promise was simple. 4 years of study, tens of thousands in debt would be a strategic investment. But the reality? It's a market that no longer values the very credential you paid so much for. The math? It just doesn't work anymore. This chart right here gives us the visual proof of that value gap. Look closely. The blue bars, see how they're just sprinting upwards year after year? That's tuition. Now look at the amber line, flat as a horizon. That represents entry-level wages. This isn't just a gap, it's a complete structural decoupling. The cost of the product, the degree, is accelerating while the market value of that same product is stagnating. According to StatsCan, average undergraduate tuition for 2025-2026 is now over $7,000. So while your debt grows, your earning potential is actually being suppressed. This chart is basically the ECG of a dying promise. So the real-world effect of this value gap is that your bachelor's degree has become functionally invisible. Think about it. A decade ago, it made you stand out. In 2026, it's just a baseline requirement. It's a $50,000 pay-to-play barrier just to get considered for an interview. And why? Well, it's credential saturation. The market is absolutely flooded with master's degrees, which has demoted the bachelor's to pretty much the equivalent of a high school diploma from the 1990s. The data is just damning. A graduate with a bachelor's in humanities or social sciences, they're earning a median of just $63,000 5 years after graduation. In a city like Toronto or Vancouver, that's not a ticket to the middle class. And that brings us to the verdicts for our first chapter. This whole narrative of being an investor in your future, it's a dangerous fiction. It's maintained by the very system that profits from your debt. When your liability outpaces your asset's ability to generate any kind of return, you've been financially captured. The system isn't really designed to empower you with knowledge anymore. It's designed to lock you into a decades-long repayment schedule for a credential with a rapidly depreciating market value. You are servicing the debt of a legacy system that flat-out refuses to adapt to the 2026 reality. Okay, now we turn to the first accomplice in our investigation, artificial intelligence. And let's be clear, this isn't some future threat. It's an active blockade that is systematically erasing the entry rungs of the corporate ladder. While all the headlines are focused on AI creating efficiency, they miss the cold reality on the ground. For the 2026 graduate, AI is not an assistant, it is a replacement. It is the force that's automating the very junior-level tasks that were once the training ground for an entire generation of professionals. This number right here, this is the smoking gun. A 13% relative decline in early career employment for young workers in the jobs most exposed to AI. This data comes straight from a 2026 Bank of Canada analysis, and it's the canary in the coal mine. It proves this isn't just some cyclical downturn, it's a targeted structural displacement. And while employment for older, experienced workers in these same fields keeps rising, the door is being quietly bolted shut for anyone new. The jobs that students borrowed $30,000 to get are the exact roles being hollowed out. So how is this all happening so quietly? Well, it's through something called the no hire, no fire dynamic. This is a crucial concept to grasp. Companies aren't firing their senior staff.
Instead, they are simply not hiring replacements for junior roles as they become vacant. They're using generative AI to do the drafting, the basic coding, the market research, things that once made up the entire job description of a junior associate. In effect, they have automated the apprenticeship. You can't get the experience you need to advance if the entry-level role where you're supposed to get that experience no longer exists. This slide draws a very clear dividing line in the new economy. On one side, you've got commoditized skills, tasks that can be automated and are rapidly losing their market value. On the other side, you have the human premium, the skills that AI can't replicate and that the market still rewards handsomely. This is the critical distinction. High-stakes negotiation, complex problem-solving, emotional intelligence, these are the new high-margin assets. And the tragedy is that the university system, for the most part, is still selling you credentials based on the left side of this slide. And this, right here, is the damning indictment of our first accomplice. The university curriculum is, on average, about 3 years behind the current pace of tech integration in the workplace. So you're paying a premium for an institutional brand, for a prestige that was earned in a pre-AI world. But you are being sent out to compete in an economy that values current, demonstrable skills over legacy credentials. That diploma on your wall, it's a lagging indicator of talent, and employers are finally starting to wake up to that fact. This brings us to our second accomplice, and it's a party that isn't just a passive observer, but an active participant in this crisis: the university itself. We really need to stop thinking of these institutions as purely educational and start analyzing them as what they've become: massive financial entities with their own balance sheets and their own revenue targets. It's a model that has become increasingly decoupled from the success of its primary customers, you, the students. All right, let's open up this forensic ledger. This table reveals what you can only describe as a geographic lottery. A student in Nova Scotia is paying over $11,000 for an undergraduate degree, while their peer over in Newfoundland is paying less than $4,000. And yet, they both enter a national job market where the credential from Nova Scotia doesn't command some kind of salary premium to justify that threefold difference in cost. There's a complete disconnect between the price of the degree and its actual market value. This is the first clue that the pricing model is driven by institutional need, not student ROI. And this chart exposes the core addiction of the modern Canadian university: high-margin international student fees. On average, an international undergrad pays over $41,000 a year. That's 5.4 times the domestic rate. This isn't just a revenue stream anymore. It's the central pillar of the entire business model. And this addiction has created a completely perverse incentive structure. Instead of investing in teaching quality, universities have been forced to compete on luxury infrastructure to attract this international capital. The institution's focus has shifted from education to extraction. So this forces us to completely reframe our understanding of the system's goals. From a student ROI perspective, yeah, the system is failing. But from an institutional finance perspective, it is succeeding brilliantly. It has successfully shifted its revenue model away from declining public funds and onto student-backed debt. It has monetized its prestige. Your debt is not a bug in the system. It is the primary feature. It's the dividend that funds the institution, regardless of your outcome in the labor market. So after examining the crime scene and identifying the accomplices, we arrive at the final verdict. The traditional path is broken, but that does not mean all paths are closed. The collapse of the old model has actually created an opening for a new, more strategic approach to building a career. This isn't about giving up. It's about pivoting to where the real value now lies. We're moving from diagnosis to the new survival playbook, the actionable strategies for navigating the hostile economic landscape of 2026. This data starkly illustrates what's called the trades paradox. Let's just compare two profiles. On the left, you've got a BHSE graduate. That's a degree in business, humanities, arts, or social sciences. They enter the workforce around 23 with over $30,000 in debt, earning a median of $63,000 5 years in. On the right, a skilled trades journeyman person. They enter the workforce around age 20 with zero debt, earning a median income of over $71,000 within 2 years. The journey person has a 6-year head start on building capital. For a lot of people, this is now the primary path to financial stability. So what's the play? Well, it comes down to this 3-step tactical playbook. First, pivot. This means you have to ruthlessly audit your current path. If you're in a low ROI program with high exposure to automation, you must change course. Stop the financial bleeding. Second, asset stack. A degree is not enough anymore. You have to build a portfolio of proof of work, projects, code repositories, freelance work, anything that demonstrates tangible skills. And third, explore alternative credential paths. Specialized technical certifications and micro-credentials are now outperforming four-year degrees in how fast they can get you to a decent income.
So we end with this question, the final verdict that you have to render for yourself. The system was designed for a world that simply no longer exists. The 2026 landscape demands that you stop viewing a degree as some passive golden ticket and start treating it as a high-risk financial instrument, one that requires precise, market-aligned execution to yield any kind of positive return. The old economic engine of the middle class has run out of fuel. The collapse is here. The only question left is whether you will pivot your strategy now or spend the next 20 years paying for a promise the system knew it couldn't keep.